All right. Hello and welcome to the Business World Virtual Stock Market Roundtable discussion titled Philippine Stock Market 2021 Recovery. I'm Lei Uy and I'll be moderating this session. So, a lot has happened since the last time we've had our regular discussion on the stock market in July. And by now, we know that the Philippine economy has shrunk by a record high 9.5%. A pace not seen at least since the 1940s, based on government data. Likewise, banking contracted for the first time in over 14 years in December, amid tightened credit standards and weak demand for loans. And on Monday, we just found out that remittances in 2020 saw its first annual contraction in 2 decades. Now, while many of you would say that the stock market is not the economy, recent events affecting the economy and the society in general have played a role in how the stock market has performed. For instance, previous announcements of the viable COVID-19 vaccines have helped the PSE index rebound from record lows in the first quarter last year, along with a marked improvement in the earnings of performance of listed firms in the second half. So where do we go from here is the question that we hope to answer by the end of this session. And fortunately, we have with us 3 esteemed individuals who have extensive experience in the equities market who will discuss for today's session. So first, I'll introduce the first speaker. We have Michael Gerard Enriquez, who is Chief Investment Officer from Sun Life Financial. As CIO, Mike is accountable for the formulation and implementation of portfolio strategies for the life insurance, variable universal life, and various mutual funds managed under Sun Life of Canada Philippines Inc. and its various subsidiaries. He's also tasked to continually enhance the capability of the investments organization to support the growing needs of the business and prepare the team for new initiatives in line with their quest for maintaining their leading position in the industry. He brings to the job over 25 years of solid and distinguished portfolio management experience, gained from stints in various insurance brokerage, Phil Equity Management Inc., and ING Investment Management Inc. Prior to joining Sun Life, he was the equities portfolio manager and vice president of BPI Asset Management. Welcome, Mike, and thank you for joining us. You may deliver your opening statement.
Okay, thanks, Leo, and good morning, everyone. Well, I think this year is really a start of the recovery story of our economy. I think we've seen last year how the market has rebounded from its lows of about close to 4,600, and we ended the year up to 7,000. So you see how the psyche of the market has moved, and usually it's sentiment that drives markets faster than the actual recovery of the economy. So with that, I think amidst historic low interest rates and the resurgence of economic activity and mobility, we think that this year will be the start of a recovery for the equity markets. And more so important is how sustainable this recovery will be, as we expect earnings of these companies to start to rebound. So I think with that, I'm happy to have further discussions with the group this morning. Thank you.
Thank you for that, Mike, for your opening statement. Next, we have Lynn Tan, who is the Vice President, Head of Research, and Chief Equity Strategist of COL Financial, the largest online stockbroker in the Philippines. As Head of Research, she handles a team of analysts who covers more than 60% of the total market capitalization of the Philippine Stock Exchange. As Chief Equity Strategist, she regularly writes market strategy reports, conducts presentations, and appears in local business programs as a resource person for stock market matters. In 2020, she was voted as Best Strategist by the Fund Managers Association of the Philippines. Welcome, Ms. April, and thanks for joining us.
Hello, good morning, Leo, and thank you for the introduction and welcome to all the attendees of Business World's virtual stock market roundtable. So, for my opening, I just like to say that, well, first of all, it's easier to be negative than to be positive nowadays. There are so many reasons to be negative, including the disappointing economic recovery of the Philippines relative to other Asian countries. And of course, since we're so dependent on the domestic economy, and yet, right now we have a high level of unemployment, poor business confidence, and a very restrictive quarantine. So mobility restrictions remain in place, and up to this point it remains controversial as to whether or not we should move to MGCQ. Aside from that, of course, our government has been very conservative in their fiscal response. But that said, you might be wondering, so am I bullish or am I bearish? When I weigh the positives and negatives, I think that I have no choice but to become more bullish. And it's because of several factors. First of all, because there the vaccines which we were waiting for and initially we did not think would happened. The pharmaceutical companies actually came out with these vaccines in record time, and although it might there are a lot of issues as far as the vaccine rollout is concerned. Nevertheless, it will lead to the eventual resolution of the problems that we have on hand. And that should allow us to hasten the recovery of the Philippines. Next thing I'm really excited about is the impending passage of the CREATE bill, as this would lead to lower tax rates, which in the first place would boost the earnings of listed companies by quite a bit. And aside from that, of course, it would allow the Philippines to attract more investments. So one of the reasons why we're not attracting investments is because at 30%, our tax rate was the highest in ASEAN. Now it's more competitive. And aside from that, since small businesses will be taxed at 20%, then that should help boost their, it's a help for them to encourage them to expand. And also with less uncertainty of what the policies will be going forward, more companies that put investment plans on hold will be encouraged to pursue them. And aside from that, well, initially this year, I felt that the market was quite expensive at 7,400. But now, well, just recently, the market fell as low as 6,600. So at that point, the PSER was trading at 18 times PE, which for me is a more acceptable level in terms of PEs. And aside from that, of course, our interest rates are really so low at this point, making stocks the only game in town. Because, well, first of all, you have a lot of stocks that give dividend yields that are currently higher than the 10-year bond rate, um, which only gives around 3%, but you have stocks giving dividend yields of around 5%. And of course, as interest rates stay low, um, it's really not compelling to be buying bonds that will only give you 3%, when in fact you have more upside over the long term when you buy stocks. Okay, and finally, you know, yes, I know that foreign investors are exiting the market, but that said, there are two reasons why I'm not viewing this as a negative. First of all, is because if you track how much investors have sold of Philippine stocks, they are back to 2011 levels, meaning they are super duper underweight on the Philippines. And if our economic fundamentals turn around, I think there is they're gonna be coming back in a big way. And secondly, emerging markets are actually becoming more attractive to foreign fund managers right now, simply because, um, well, we stand to benefit more from the rollout of the vaccines because we were hurt more initially. And if the US dollar remains weak, which a lot of people expect it to be, um, emerging markets will benefit more because of our higher interest rates, um, higher yields of foreign currency instruments versus dollars, and of course rising commodity prices are benefiting emerging markets that are exporting them.
All right. Thank you for that, Miss April. Next, last but not least, we have JC Bisnar, who is CEO and co-founder of Investagrams. When he was 20 years old, he realized there were vast opportunities to be made in the stock market. By giving immense focus and dedication in developing his trading skills at a young age, he was able to gain his first million in the stock market at age 21. Since then, he took it as his advocacy to share the positive impact of the stock market to his fellow traders. In 2014, he joined forces with JM Lapina and Erwin Tin to co-found Investagrams, which is now the leading social financial platform in the Philippines. Yet, even with a fast-growing startup on his hands, JC has not lost his passion for trading in the stock market. Alongside his duties as CEO, he also trades for a living on the side. Thank you for joining us, JC. Please.
Hi, Leo. Thank you for having me here. So first, pandemic. A lot of people were surprised by the crash, but then the recovery was so strong. We had a 50% or more rally coming from the lows. So tons of retail traders or investors actually made money if they either doubled down on the bottom, whether on the 5,000 or 6,000 level. So tons of traders made money. But then the key now is what to expect moving forward, because for me, we look at the PSEI last year. We've recovered almost on the post-pandemic levels at 7.2, 7.4. So we were iterating that, hey, let's pause for a while. Let's not be too complacent with what's happening around us, because recovery will definitely come, but then it won't be in one snap. So we always have the option as retail investors or traders versus the big funds where they have to be fully exposed most of the time. What we tell our people in Investa is that you have the option to be more selective, whether in terms of your exposure or your stock selection. So you don't have to be fully exposed at these current levels at 7,000 and above, which is just like fair value. The upside isn't so attractive at this point for me. So I think we can discuss that further in this forum. So I'm really grateful to be here, and thank you.
All right. Thank you for that, JC. So with the introductions out of the way, so we can now proceed with the discussions. So first, my first question is really more on the macroeconomy. So I hope you guys don't mind if we discuss that first before tackling the stock market. So to give the viewers some context. So know now that it's negative 9.5% in GDP decline in 2020. And much of that was driven by the negative 7.9% decline in household spending, which, to put into perspective, was even sharper than the last time we've had this decline in 1985, which was at negative 0.5%. So the question really is this something that we can expect to recover from this year? Maybe regardless of whether there's base effects or not, is this something that we can expect to bounce back? Maybe we can start with Mr. Mike for this.
Okay, thank you, Leo. Well, I believe that we can start to recover on the household spending, and I think we need to dimensionalize the causes of the steep contraction in household spending. And for one of the obvious reason is we are on lockdown and quarantine, so there's mobility has been restricted. Second would be a lot of jobs were lost, a lot of workers were dislocated, a lot of OFWs were sent back home. But if you think about it, the question is, would people have enough cash still to start spending? And one of the biggest factors of this is confidence level. And right now, last year, we were all on preservation mode, so to speak, and we wanted to hold back on any unnecessary spending except for food. And if you dissect the sources of household spending, it would be really food, going to restaurants, going to movies, spending time in malls. All those were gone. So then again, it's a question. It's a combination of people having money but could not spend, and some of the people could not no longer have much to spend because they lost their jobs, or if they have savings, they won't spend it. They'll just probably save up on these things. But as we see the economy start to reopen, especially now, if you visit your nearby mall, you see more activity happening, and we see jobs starting to be created again. You'd see more confidence going back, and then people will start to spend again. And we all know for a fact that a lot of the people who were displaced, as Filipinos, we are all creative, and there's a lot of underground industries that have started. I'm sure we all had our share of ordering online, all these specialty food items that created an underground economy as a alternative source of income. And likewise, we've in Sun Life, and we've also noticed a lot of interest to be financial advisors. So as an alternative for those who were displaced, they wanted to take on another type of work, and then reinvented themselves. So I guess my point is, we believe that as we see the economy start to recover and the quarantine measures start to ease off, we can see more household spending coming back on lines.
Thank you for that, Sir Mike. How about you, Miss April and Sir JC? What are your thoughts on this?
Yeah,
Sure.
can I start? Okay. Yeah, for me, my view is, well, to tell you honestly, I'm not like 100% bullish. I understand that, these economic numbers are bad, and they are. I'm not going to deny it. But, upon reflection, my thoughts are like, why are people so excited about these vaccines? It's more of, first of all, um, now that the vaccines are there, I guess the question is, it's a question of when, but not if. So people will definitely be allowed and have the confidence to go out again and start spending. It's more of a question of, when this can happen. So when can we reach herd immunity? If not 2021, then maybe 2022 or 2023. So that's the first thing that I'd like to say, as far as the recovery in consumption is concerned. Secondly, of course, as you can see, our OFWs have been very resilient, and they've continued to send money. So maybe if we are a little bit palpak in our rollout, we still have these OFWs who, I mean, in other countries, if they're more successful in rolling out the vaccines and people become more confident in going out and they open up the economy, then, they're going to recover faster, and they will be able to send more money to their relatives in the Philippines. And to some extent, this will also help boost local consumption. So that's my view on consumer spending, which is why, even with the bad numbers, I try to be more forward looking and focused on, the future. So I feel like, at least, okay, last year we didn't know when this was gonna end. There was no light at the end of the tunnel, but now, there is a little bit more visibility as to when, things are gonna end. So I think that's why I am more bullish today than I was maybe late last year, or early to late last year.
Thank you, Miss April, for that. Sir JC?
Yes, I agree with Miss April's point. It's just a matter of when the recovery or the vaccines will come in. So the recovery, the economic recovery, is definitely inevitable. So what we're trying to look at here, if you go outside, you look at the malls, the casinos, almost all these places are operating at 50 to 70% capacity. So actually, if you just remove the protocols, the limitations, I think the fear of the people have subsided already. So the effect of COVID has been neutralized or will be neutralized. If you look at hospitals, they aren't bombarded with patients anymore. So it's just a matter of time where the economy slowly normalizes to 80% of the usual. So that's my belief. So regardless of what happened before, sooner or later, as the vaccines come in, then things will normalize, hopefully in the latter half of the year.
Thank you, Sir JC. So the reason I ask that question is that when we talk about income levels, usually consumption comes into play. So I think it's a proxy indicator of how much disposable incomes are left among households. So my question really is, how much does this component factor in your outlook regarding the appetite of retail investors and traders towards investing in stocks? Does this mean that when consumption is expected to rebound, does that immediately lead to people spending more in stocks or other risky assets? Maybe we can start with Miss April for this.
Okay, so as far as that's concerned, okay, first of all, I think, I agree with your earlier view that the performance of the stock market is in some ways not entirely reflective of the economy, the general economy, because first of all, the people who are buying stocks in the Philippines is less than 1% of the population. Okay, maybe 2% given the increase in the number of investors. But that said, I would suppose that more than 2% of the population has excess money and are looking for alternatives as to where they will put their money given the very low interest rate environment. I mean, time deposit rates are less than 1%, no? Bond rates, again, 3%, and then you have to pay your 20% withholding tax. And I think another factor why people are a lot more interested in stocks is, to tell you honestly, like from our experience as a retail broker, the influx of investors came in starting March, and you have a lot of newbies coming in around that time, and they have not seen a bear market. So from March to today, the market is up a lot from 4,600, and you have a lot of people making money. That's why, they made a lot of money from 4.6, and then they're holding on to their gains. That's why they're a lot more excited to keep on buying stock. So I think that's one of the reasons why, diba, in the past, if you had this mania on speculative issues, it will only last for a few weeks and then it will die down. But this time around, you see it lasting for a very long time. And it could be because, they've been making money all the way since March. They have not lost money, and they are a lot. So I think that's one of the reasons why they continue to invest in this market. And we've been able to go up even with the absence of foreign investors.
Thank you for that, Miss April. That's actually a good point. How about you, Sir JC?
Yeah, so definitely the income levels of households were affected due to lost jobs, or some companies had to cut their salaries or adjust their work requirements from people. So that definitely has an impact. But then what people realized in the pandemic was, if you lose the sense of stability from your job, then what are you supposed to do? If you look around the different industries, a lot of people had to resort to other means to make money, whether that be online business, freelancing, e-commerce, and then the stock market. So that's one reason why a lot of new investors came into the market, because generally people were just looking for, how can I make money outside of their regular jobs? And to put into consideration, everyone was in a lockdown. Of course, you're so bored in your house, you have to do something, right? So I believe that will provide, that realization will be the catalyst in spurring the growth of influx of retail investors, not just in the pandemic, not just because of the pandemic, but I think moving forward, people will realize that, hey, I can't just rely on my job stability. I need to do something else to take care of my financial wellness. So that's my view on that. And I think moving forward, we will continue to see stronger growth in different industries, whether online business, freelancing, or in the stock market itself.
Thank you, JC. How about you, Sir Mike? Sir Mike, your mic's off. You're get unmuted.
Okay, rightfully pointed. For the Philippines, consumption comprises the biggest portion of our GDP. I think it's close to about 70% of our GDP is driven by consumption. And clearly, once we see consumption rebounding, and for the Philippines, the major industries are really related to a lot of retail. I think the biggest capitalized stocks in the PSEI are all related to retail business. I think the malls, real estate, restaurants. So as we see the economy again start to reopen, more confidence it gains from investors and from the public, from the ones who consume. And I think it will create a snowball effect. And if we see mobility restrictions being lifted or being more relaxed, we can see more activity. I think the critical portion on consumption for that we've observed is the mobility restrictions was centered towards 18 to 65 years old. And for us Filipinos, it's important for us to bring our kids to malls, to restaurants. And that's why we've noticed that the hardest hit restaurants were the family-oriented restaurants. People may not have the capacity to spend, but for those who have the capacity to spend, are just staying at home because they cannot bring their kids to malls and dine out. So as we see mobility restrictions getting eased more, then probably we can see a rebound in consumption. And it's very critical as we see consumption as the largest component of our GDP. And I think investors will start to latch on to this. And as we all have seen, sentiment drives market faster than the actual economic recovery.
Thank you, Sir Mike. So from what I can gather from your responses, you're saying that consumption, if there's any effect, is not as big as we expect or we'd like to have it. And instead, it's more on sentiments. Am I correct?
Well, for me, not entirely, because we all have to also consider the fact that there were a lot of people who were displaced. Although the OFWs were sent home, it's quite surprising that the contraction was just less than 1% for OFW. So it means that there's a lot of money that continues to be sent here for spending. But I think the other dimension to that is the hesitance of people to really spend more, because I think a lot of realizations after the lockdown on what's important, and for those who would want to spend really could not spend because of limitations on mobility.
Thank you for that, Sir Mike. Interesting insights there. So with consumption out of the way, I'd like to ask this next question regarding government. So what are your assessment on the effect of government has had on the stock market in 2020 and so far this year? Do you think there's still ample room for fiscal and monetary policy to influence the stock market by this point? Maybe we can start with Sir JC on this one.
Yeah. So looking at what the government has done in how to address the pandemic, they try to put efforts, but then a lot of things can still be improved. So if you look at how our government has handled the whole pandemic in our country, compare it to other countries which are more progressive, you can see that it is a factor why Philippines right now is lagging compared to other countries in the region. Like example, Vietnam. Vietnam is trading at near highs. China China, Taiwan has handled their issues very well. So I think that will be a factor in how our markets move forward.
How about you, Miss April?
Yeah, I think it's well, for last year, I think one of the best things that the government did was, well, more of the monetary policy, where where the BSP, reduced the triple R's aggressively, and then they cut the uh, the interest rates a lot. So it boosted liquidity, and it helped companies raise funds. Well, the big corporates were able to raise a lot of funds, so that helped a lot. But on the fiscal side, they can do a lot of things actually. Again, they've been quite conservative on the fiscal spending front, and then on the government spending, if you look at the GDP breakdown, it's quite slow. And it's quite disappointing from that respect. Now, what can they do this year? I mean, I think first of all is, hopefully they are able to spend the amount of money that they say they will spend on infrastructure. Secondly, again, on the vaccine rollout, I hope that it will be a successful vaccine rollout. And well, at least on the positive side, when you look at the budget that has been set aside for the procurement of vaccines, it's a total of 82.5 billion, which is enough to finance the procurement of their planned 148 to 170 million doses. So if that were the case, and they are able to convince 70% of the population to get vaccinated, then we will reach herd immunity, and that will accelerate the recovery of the economy.
Right. So you're saying that there's definitely room for the government to prop confidence in among
Oh
investors.
yeah,
Yeah.
definitely. And not to mention the fact that, you remember last year when we entered this pandemic, we entered in a position of strength where our debt to GDP was actually quite low. Meaning nobody cares at this point if you spend a little bit more, right? Because we're in a pandemic. I mean, think of the US. They're going to spend 1.9 trillion US dollars, and they're actually not in a good shape. So, but I mean, I don't know, like, we have to understand where the government is coming from, because they're quite conservative in their fiscal response, and they feel like dole outs are not necessary and not effective. That's why they use the create bill or other things. So okay, let's give them the benefit of the doubt that those things are better.
All right. Thank you, Miss April. Sir Mike, your thoughts?
Yeah, well, I agree with what April mentioned. I think the BSP was very instrumental last year, as they were in the forefront of helping the economy by cutting interest rates aggressively. The policy rates was cut significantly. They've added more liquidity by reducing the reserve requirement of banks. So, and the other thing that was a first for the BSP was they started buying bonds in the market. And this was akin to what was happening in the US, similar to quantitative easing, where they've been buying bonds and injecting cash in the system. So apart from lowering interest rates, they've added more liquidity by buying bonds in their balance sheet. So it was a first for the Philippines, and it was also a first for market players. That's why we've seen interest rates hit historic lows. And this has been very important for the companies to be able to borrow at lower rates. And last year, we've seen, as what April mentioned, we've seen a lot of borrowings last year, but the borrowings from companies was really more for their working capital, not really for expansion, as they would really need to address the dwindling cash reserves. In terms of the fiscal front, I also agree that I think this is what the government really needs to focus on. Last year, they've started the Bayanihan 1, Bayanihan 2, but I think that's not really enough. What we need would be more to see is more major fiscal spending, like focusing more on acceleration of the PPP projects, the infrastructure rather, not the PPP, the infrastructure projects of the government, really spend in the critical bills like the Create bill. We're glad that the FIST bill was already signed. So all of these fiscal stimulus package would be the next step for our economy to really start to recover. And lastly, I also want to note that it was a good move by the Bureau of Treasury and the Department of Finance to borrow in US dollars. I think last year we borrowed a lot in US dollars. That's why we've seen the dollar peso rate really go to about break 48 level, and our gross international reserves have hit at least at about 1 year worth of imports. So I think that has strengthened the balance sheet of the government and the capacity to curb any volatilities in the coming months.
Thanks, Sir Mike. So now we move on to the market itself. So the next question is really more on factors. So it's been almost a year since the Philippines was put on lockdown. So you know, you have investors looking into developments on the vaccine, and as well as their anticipation on when will the economy, you know, go back to pre-pandemic levels, and so on and so forth. Question is, are there other pandemic-related factors that you think markets haven't priced in yet by this time? Maybe Miss April, you can answer this first.
Pandemic-related
Or
factors.
other.
I don't know. I mean, my feeling lang, okay, here in the Philippines, I think there's opportunity more on stock picking, as JC Bisnar had mentioned. Because, okay, the foreign fund managers are focused on buying the big cap issues. That's why when you look at, say, the index, we are expensive. And stocks that are the large cap stocks that are vulnerable to, say, the pandemic or sensitive to the pandemic are trading at 30 times PE, 40 times PE. No, so it's more of that. May index bias, pero what's not factored in is that you have a lot of cyclical companies that, you know, are not as popular, that are still trading at very cheap valuations. A lot of companies, for example, say banks, are trading below book value. They have lagged behind the performance of other banks around the world who have rebounded substantially, because, you know, the banks, for example, when you talk to them, yes, they're still a bit worried that the NPLs will peak in the end of the year, or they will still go up, etc., etc. But that said, you know, what has changed is that this year they're saying, hey, we did the possible peak in NPLs is not going to be as bad as we initially thought it would be, and we've set aside so much in provisions. Yung mga ganon, I don't think they're factored in given the valuation. So I think there is some opportunity to do stock picking from that perspective, from that end. And if you have a long-term investment time horizon, then maybe it is a good time to actually start accumulating stocks.
Thank you, Miss April. Sir JC, maybe you have something to add to that?
Yeah. I'm not concerned. I think anything pandemic related has been like the fear or the sentiment on pandemic has been too much out there or saturated. It's been overdone. So I don't think there's, even if you count the second strain or whatever other development will come from the pandemic, there will be little surprises that can make a strong impact in the markets right now if we talk about pandemic related things. But what I'm more concerned about is we're almost in a 10-year cycle of a low interest environment. So 10, 12-year cycle since we entered like the zero interest era. So that's something you have to look at on a global perspective, these big changes that could potentially happen worldwide. So while everyone is focused on pandemic, we've forgotten that, hey, what's happening in the macro economy, in the global economy. So if there's sudden negative catalyst in the USA or something happens in the other major economies, then that's something that we have to be aware of rather than the pandemic itself, because I think that will be heavily subdued. The pandemic will diminish over the year. Vaccines will come in. Israel has already tested majority on their population, and they've shown great results. So it's just a matter of time. Pandemic isn't a concern. It's just a matter of time. So we should be looking at the bigger picture instead. And I agree with Miss April. Despite the factors on the economy, it's really about stock picking. It's not about buying the whole market or the country. It's about finding the leaders, or at least heavily battered names that have been heavily impact in the pandemic story, in the closure of the economy. But now that we see the potential reopening, you start to look at the valuations, which stocks have been so battered that they enter no-brainer levels. So whether that be in banks, some consumer names, or some businesses that haven't been affected with the physical limitations of the pandemic, then we try to look at these companies and focus on them rather than looking at most blue chips trading at fair value, 30 times, 25 times PE, with no strong catalyst on them outside of the reopening. So there are tons of interesting names or ways to make money. You just have to find the leaders or the outliers, not just the broad market. So that's my view on this.
Thank you, JC. Sir Mike?
Yeah, well, I agree with the views. I think there's a lot of opportunity already being presented now. A lot have already been factored in to the prices of the stocks. There are some risks, obviously, that might be still there. Resurgence of COVID-19 cases, a delay in vaccines. But I think, as what they pointed out, most investors are now focusing more on valuations, looking at which companies will benefit for a rebound of the economy. I think, for one, a lot of the institutional investors have shifted from defensive to now the cyclical stocks, and these are your consumer names, your retail, the construction. As an investor, you need to be ahead. You don't want to buy all these names when the economy has already rebounded. You wouldn't want to buy when there's a lot of uncertainty still, but you have something to look forward to in terms of a recovery story. And as an investor, I think this is the right time to do so, as there's still a lot of uncertainty, but there's a glimmer of hope already when we can start the recovery process.
Thank you, Sir Mike, for that. So right now, I think it's earnings season, or was it last week or this week? So given that what you're seeing right now, maybe I think JFC released theirs lately on the full year 2020. Although a lot of these are we're yet to discover the fourth quarter figures. So for those that have indeed released full year, my question is, would you say that these were close to earnings expectations last year? And if so, or if not, what are your expectations for this year regarding earnings? Maybe Sir JC, start first.
Yeah. If you look at most earnings reports last year, I think most of them came within expectation, because when you see the negative earnings reports from different companies that were affected, example, even the worst ones like the airlines, you don't see surprising movements from companies like Cebu Pac, right? So even if they release a super negative earning or whatever, everything has been priced in already. So everything moves within expectation. So in the past, we all know that the companies have been affected by pandemic. So that doesn't matter anymore. So what matters now is which of these companies can innovate enough or are resilient enough to actually recover fast. And what are they doing about it? Like, some companies are aggressively raising funds. They're offering more shares. Some companies are expanding into other business lines, are innovating their business model. So that's what I'm more concerned about. Most, I say 90% of earnings last year were within expectation, but there were some companies actually who there were some banks like BPI, they had earnings that were more resilient compared to what was expected. So I think that's one clue on how to see like East West Bank, BPI. You see some banks that, hey, their earnings weren't affected too much. So that's a clue that they've managed their operations well despite all the negativity, despite all the challenges. So that's what I'm more interested to look at rather than seeing if the earnings were within expectation. So it's more of which companies were stronger or more resilient.
Thanks, JC. Sir Mike?
Yeah, Leo, this is a good question because I think last year, at least as far as our analysts are concerned, we did several revisions in our forecast, and this was really more of a function of how long the quarantine measures would be. Obviously, initially from March, we were thinking it was just 3 months. Then it started 6 months, and then it up to now we're still in quarantine. So there are a lot of revisions in terms of the earnings forecast. But for us, for some sectors we were more optimistic, and as we see the fourth quarter earnings reports come out, I think some of the retail names that we were more optimistic on turned out to be more negative. And some of the ones that we are more pessimistic on turned out to be more positive. I think for one, I think the banks, what we had difficulty in estimating would be the level of reserving for them. So that was the one that differentiated the forecast. For the consumer names, really it was more of a function of the mobility restrictions, the quarantine measures on how it was factored into our forecast. But for this year, since earnings contracted significantly for last year, I think we are in a more optimistic view of a strong rebound of close to about 40% earnings growth across the PSEI names.
Thank you, Sir Mike. Miss April?
Okay, so on the earnings, well, here's the thing. I mean, if the companies deliver weak earnings, parang okay, it's expected. There's a pandemic. We were only guessing how bad is. So if it's bad, okay, not surprising, it's bad. Yun na nga. Pagka good, yung good actually, that's more surprising if you come out with good earnings. Okay, for the fourth quarter, it's still early days right now, but for us, it's not enough to see the headline numbers. Kasi we look at the earnings on a quarterly basis and we want to see whether, for example, nung third quarter earnings season, was third quarter better than second quarter? How much was the improvement? On the fourth quarter, is fourth quarter better than the third quarter? And what is the improvement like? And then, of course, finally, what's the share performance? Did the company perform? What's the market thinking? Are they negative about this company, and or are they positive already? Tapos biglang ang sama pala ng earnings, or you have to factor all of this into consideration. And aside from that, it's not enough to just look at the headline numbers. You also listen into what the guidance is. Nagbago ba yung tone ng voice ng management na from a very cautious outlook, all of a sudden they tell you the worst is over. With conviction, we expect the earnings next year to be double-digit higher, or to double, or we're confident that we will be profitable already from a loss. Yung mga ganong statements, we really pay attention to them, and so why are you saying this? Where's the recovery gonna come from? XYZ. So yun yung mga tinitignan namin eh. It's not just plain vanilla earnings, at this point.
Right. Thank you, Miss April. So what's actually interesting about earnings right now is, yes, we do expect that these are down given the pandemic, but maybe it's more of the degree to which they were down. So if it's just a slight negative, turnout for the fourth quarter, maybe we'll consider that we'll take it. Basically, that's what we're saying. Maybe in the case of banks, for example, we're seeing an increase in provisions, and yet they're still able to record a slight decline at least. So maybe it's more degree, right? So okay. So I think that let's move on to the next question. So I actually want to go back with the factors because Sir JC mentioned earlier that maybe it's not just a pandemic that we should be looking out for this year. So in that sense, are there other factors both at home and abroad that should investors and traders take into consideration? Sir Mike, your thoughts on this?
Okay. Yeah, well, definitely there are a lot. For one, the global market, especially the US, have been hitting all-time highs, and we don't know how sustainable this will be, but I think earnings will continue to be supportive, but definitely it is ripe for a correction. And obviously, even if the Philippine equity market hasn't rebounded yet, we will be affected by any global disruptions in financial markets. We have been noting as well the increase in US Treasury rates as they've been highlighting inflation fears in the US. So that might disrupt the equity markets in the US as we see the 10-year rate reaching more than 1.2%. And that has come from below 1% a month ago. So that's something that we're watching closely as we see if interest rates start to move higher, then that might trigger a correction in the US market, which might affect the Philippine equity market as well. Domestically, I think we need to recognize that by the second half of the year, the focus from pandemic response to election-related matters will be the main driver for news wires right now. As we see, of course, 2022 will be a presidential election year, and that is something that we need to consider for our economy and for the performance of the equity markets.
Thank you, Sir Mike. Sir JC, maybe is there something that you want to expound on your answer earlier?
Yeah. Yep. So I agree with what Sir Mike said. Definitely the thing to look forward to on this latter half of the year is the election. So you want, as a retail investor, you want to focus on which names or companies would be highlighted on the pre-election or election story coming in that zone. So second half can be utilized to accumulate those names, whether that be cement plays, construction, consumer names, I don't know, like media related plays or whatever. So it's a usual cycle where we see the election plays come in on the latter half. But then that's a long way to go. We have 4 months. So for that 4 months or the first half, I'd rather be more conservative. Like you look at USA, it's all-time highs. But then, like what Sir Mike has mentioned, is this sustainable? If there are sudden catalysts, I think most people have been too focused on pandemic, but then we forgot about the debt levels. So what are they doing in terms of printing money? Are they just going to continue their monetary policies? So is that even sustainable? And in relation to that, you look at the viability of US, the strength of US as a whole in relation to their currency. Now that we see the rise of cryptocurrencies being pegged as the future, you see Elon Musk hyping it, and more companies have started to accept the concept of alternative currencies or crypto. Then you will start to question or put into contrast, how does that impact the viability of the US dollar as a currency? And if more people start to change their behavior on that could be a big thing. It may not be obvious today. It's starting to happen right now. But then if less economies rely on the US dollar, then how would that impact the US economy as a whole? They're going to start to lose their power, their ground. We don't know how they're going to react with these coming changes, but that's definitely an interesting factor to watch. So as of this moment, first half, I'm a bit more cautious. Like my approach is sell on rallies. If there are overhyped stocks or overhyped valuations, I would sell them, and I'd be more picky when it comes to my stock selection or the spots where I put conviction money in. So that's my main point.
Thank you, JC. Miss April, is there something you want to add to this?
Yeah, so I think naman they kind of covered everything. So, but the risk that we usually highlight with our clients is the rising inflation and the potential impact on interest rates, because to some extent the recovery we're seeing is related to the low interest rate environment and the ability of central banks to maintain a very loose monetary policy. But that said, um, at this point, at least, the inflation that we're seeing is largely supply side driven. So we are hopeful that as the economies reopen, the supply side issues will be addressed. And secondly, central banks are quite cognizant of this. That's why they are a little bit cautious about tightening too early, and they're allowing things to go a little bit hot. No, and yun na nga, I think finally on the central banks, well, they've kind of learned their lessons in 2013, the US Fed, actually, when there was this taper tantrum that took place, and they allowed the 10-year bond rate to climb up when they hinted that they would stop the bond buyback programs. And lo and behold, after that happened, and the markets went down, they announced another set of QEs. So medyo cautious na sila ngayon from that respect. So I think the central banks are going to be a little bit more forgiving as far as inflation is concerned, and being hasty in pulling out the loose monetary policy.
Thank you, Miss April, for that. So the next question is really more on metrics. So you've all mentioned earlier developments, events, or other policy related stuff that may affect stocks in the future. So I just want to ask, for the benefit of our viewers, what key performance indicators, may it be fundamentals or technical, are you looking at firms right now in evaluating their attractiveness long term? Wants to take a stab at this first? Maybe Sir JC?
Yeah, okay. First, I myself, I'm a technical trader, like 70%, 80%, and then I use fundamentals or catalysts to screen which stocks have stronger potential. So if you're a retail trader, you want to see which stocks are creating sustainable bases. If you're looking at bottoming pattern formation, so you want to see stocks that have created 6-month basis, and then you want to see if they're able to break above that 6-month range. So if you want to look for cheap names, and then of course you want to add fundamentals to that. You want to see how much are they trading relative to their historical values. After the pandemic, do you see potential growth drivers in these names? So those are for bottom picking names. But then if you want to see which stocks are really going to lead the market, I want to look at stocks that are trading at 1-year highs or all-time highs levels. So probably there's a strong reason why some of these names, despite the lackluster market right now, there are a few names, like 4 to 8 of them, or less than 5, trading at around all-time high levels. So there's probably a strong catalyst there. Is there a business driver that will add potential revenues or valuation of these companies? And then on the earnings side, you want to look at which stocks can sustain more than 30% growth, 50% growth, whether that be on their earnings, and then on their relevance or their significance on their industry itself. So if I was looking at stocks, I'd be focusing on stocks that can perform or are in exciting industries. So the one half of that are stocks that are going to benefit from the coming election. The other half of that is the stocks that are benefiting from the concept of digitalization. Even if it's been there for a while, the pandemic has iterated it and made companies are forced to focus on that. Investors are forced to focus on that. So plays such as e-commerce related plays, fintech, internet, the internet plays. So you're gonna see some of these stocks, interesting names that are trading within 1 year highs or all-time highs. So that's where I want to focus on. So it's either you look for strong, high growth, exciting stocks, or you look for super battered but with a potential turnaround with the reopening economy stocks, and you look at the price action if they're making these sustainable 6-month basis. That's where you start to accumulate them. Yeah.
Thank you, JC. Miss April, you mentioned earlier not just vanilla earnings, so maybe you can add something to this. Your mic, I think, is off.
Yeah. Okay. So I think what's important is, the industry where the company belongs to. Is it still going to be relevant under the new normal, or has it been disrupted? I think that's most important. And then secondly, well, as far as earnings are concerned, if the company, say, is losing money, the question is, well, are there improvements on a quarterly basis? And if there are improvements, at least is the company even reaching, or does it have a solid plan to at least break even on an EBITDA level or on a cash flow basis? Okay, you don't have to be positive in terms of net income. You have to be EBITDA positive. So it's just cash flow positive lang, at least. No, because of course, when the economy reopens, the hope is, first of all, as I've said, from an industry perspective, are you still relevant and are people going to come back? And secondly, do you have what it takes to survive? Do you have a solid plan to survive? And our earnings actually recovering slowly on a quarterly basis. Parang may pag-asa ka ba or wala lang, di ba? So I guess that's as far as we're concerned when we look at companies. And finally, of course, the valuations. Definitely, if you're going to be affected, I'm not going to pay the same kind of valuations that I used to. No, I want to pay cheaper prices. No.
Thank you, Miss April. Sir Mike?
So probably just to sum up what the JC and April mentioned, I can sum it up into three factors: sentiment, fundamentals, and valuation. And I think these are the three factors that we use as well when we look at stocks and we choose at stocks and we decide on entry levels and the equity market. Well, sentiment definitely is the first driver of direction, whether up or down. It's sentiment that will dictate this. Next would be the fundamentals. And as what they mentioned, we have to look at companies that will remain to be relevant and will be the ones that can take advantage of this, whatever form of this new normal will be. So, and we also have to consider the direction of the overall economy and which sectors will take advantage of this direction of the overall economy. And lastly, we have to cross-check it with the valuation. Are we buying companies cheap or expensive? And sometimes you just don't buy companies because they're cheap, because sometimes they're cheap for a reason. So that's why we need to incorporate these three factors whenever we choose the stocks, the individual stocks, or entering the equity market as a whole.
All right. Thank you for that, Sir Mike. So, okay, questions more on investment opportunities. So, for stocks, are there particular sectors that you're keen on, loading on positions into? I think Sir Juicy already mentioned about companies that are likely to be highlighted during the elections. But are there other sectors that you're interested in? Maybe Miss April can go first.
Okay. Yeah. So we talked about, well, earlier on, I talked about the low interest rate environment. So because of that, I think it would be good to buy, say, the telcos, because they provide a good dividend yield. And I mean, to a certain extent, the profits have been relatively resilient. because people actually need data right now. And that said, the dividend per share will most likely still be good going forward. And then, of course, the REITs, we like them. We've also been recommending the banks because we feel like, they're a good recovery play, and yet they were one of the worst performing sectors last year due to concerns about how high the NPLs would be. But now my feeling is they have not yet caught up. Then you do have a few companies that, are not as that remain very cheap despite the fact that earnings are set to recover, and you actually see insiders buying them, or a share buybacks program like GT Capital and MPI. So yeah, there are quite a bit of opportunities out there.
Thank you, Miss April. Sir Mike, your recommendations?
Sure. Well, as what April mentioned, I think some of the dividend-related stocks would still be good as a defensive play. But I think for us, we are looking at more on the cyclical sectors, which are the real estate, the banks, the construction companies, which I think will have a hand in the recovery story of the country. In looking at the individual names, I think it's a good way to always follow the smart money. When I mean smart money is insider buying. And as what April mentioned, we've all seen a lot of company buybacks, and those are practically insider buying. And if the companies themselves think that their share prices are cheap, then so should we as investors. So I think we need to follow the smart money, the insider buying as well. But for us, the cyclicals, the consumer discretionary sectors, definitely will re-emerge as consumers will start to be more confident in spending again. So these are the likes of the Jollibee, the Emperador, um, and gaming. I think gaming is a sector which will enjoy a good recovery as quarantine restrictions are more relaxed.
Thank you, Sir Mike. JC?
Yeah. So I think mainly everything was discussed already. So just to iterate on the key points, first would be companies that are tech relevant. So telcos are there, but then not all of them are adapting to or providing services or direction that is relevant. So we have to choose which ones are ahead of the pack in terms of providing not just the telco or the data business, right? Because most telcos, they do not act like a pure telco play anymore. A lot of the telco aspects are on other tech related peripherals, right? So that's where something interesting to look at. So if you compare PLDT versus Globe and we reflect a bit, you're going to see clearly which one is the leader or which one is the laggard. And then on the other hand, construction, yes, for the pre-election, and then consumer names that have been closed out will the reopening is inevitable. So there would be the big caps such as Jollibee, but then it's also interesting to look at. I haven't looked at the valuations of, let's say, Pizza, Max. So these more small or mid cap consumer names, the food place, they may be interesting. And then this week, we also highlighted to our Investa subscribers the potential of gaming names, because I've been to the casinos recently just to make a site visit and eat around. And surprisingly, people do not seem like they care about the pandemic. It's like regular. It's like a regular environment in the casinos, except for the extra like sanitation metrics, sanitation protocols. So definitely, if the casinos are operating at 50-70%, depending on the day, then what more if they loosen up the protocols on the MGCQ or the limitations on the pandemic related limitations. What else? Looking at the banks, it's also about technology. There are the boring banks, but which ones on the banks are adaptive to the fintech related place? So that's something interesting to look at as well. if you're going long term, because not all of them, some of them have been lagging on digitalization, or they haven't invested in that heavily. So I'd rather focus on banks that are really serious on their tech related components.
Thank you, JC. So I think this will be our last question for the panel discussion, and your answers to the question will serve as your closing statement. So we know that each investor and trader has their own strategy, and it's probably best if they follow that strategy onward. But even so, what advice would you give them, newbies and veterans alike, with regard to navigating the stock market for this year and beyond? Let's start with you, JC.
Oh yeah. So if you look at last year, it was too extreme, right? We had a drop from 7,000 to 4K. So if you didn't have any risk management protocols, you would fully experience the downside, and you would probably quit on the market already with that kind of pain, right? But for a lot of us, if we practice some degree of risk management, whether that be in diversification of your assets, putting some in stocks, some in bonds, some in property, or diversification, or putting risk controls where if there are certain warning signs, then you minimize your exposures on the market. Then in this kind of environment, this is where you'll appreciate the power of risk management. So we see the coming influx of a lot of new traders. So as you discover your strategy, whether you're a technical, more short-term oriented trader, whether you're a long-term fundamental passive type of investor, the middle point on that, the intersection point of that, is strong risk management. So if you're able to apply that, regardless of market cycle, you will always survive, and you will always survive the down times, and you will always be there on the good times. So that's the sense of risk management. It's about knowing when to minimize your exposures if the market is dangerous or showing warning signs, and then knowing when to be aggressive or increasing your exposures when the markets are showing good signs. So I hope that as investors, we work on that, because you can't just say that, hey, Philippines is good, I'm gonna buy all kinds of companies, and then you expect to make money blindly just by following other people or buying blue chips regardless of without proper research. So there's that strategy component and the risk management component, and if you put the right work on it, and if you have the right framework at hand, then profits will come in over time.
Thank you, Mr. JC. Ms. April, your advice?
Yeah, I guess I'd like to add some more on the risk management perspective. Okay, so for example, I've shared that I'm bullish on the stock market, and of course, we would recommend buying blue chip stocks. But that said, again, the fundamentals aren't great, so that could mean volatility, or secondly, some delays in the improvement of the economy, meaning stocks could stay stuck here for a bit before they actually start to recover. So that said, risk management in terms of diversification, buy more than one stock. Secondly, risk management in terms of also controlling your size. Make sure that what you're using to invest in the market is not something that you will need in the next few days or weeks. Maybe this is money that you can keep for quite a bit, no? And then given the popularity of a lot of speculative stocks right now, we have talked a lot about them on how to participate. I guess, one thing that I'd like to, strongly advise new investors who get lured into buying these third liner issues because they're exciting is, to avoid the temptation of actually buying more on the way up. Okay, because that's usually what happens. During the start, takot na takot ka kasi it's all chismis. But then when you start making money, you become greedy and buy more of it. Actually, the strategy has to be, as the stock goes up, you're actually exiting. And don't wait until the stock shows signs of weakness. Because remember, when it's going to go down, there's going to be a stampede of sellers coming in and you will not be able to sell. So better to sell on the way up, and bahala na even if you don't get the best price or it continues to double. At least you made a lot of money, and you will be able to continue participating in future, run ups of other stocks, because there will definitely be more opportunities in the future.
Thank you, Ms. April. And finally, we go to you, Mr. Mike, for your advice.
Okay, so well, for my final word, I think there's a lot of opportunities for the equity market this year. As an investor, you just have to remember that you have to do your homework. The thing that we have been observing with our clients is they just get and join the bandwagon. And what we have been trying to communicate to them is really you need to try to assess and do your homework before you jump into investing. There are a lot of platforms out there that can enable you to get that information readily available. I think Investagram, for one, I would admit that I'm a user of Investagram when I'm outside the office. It's a free app. It offers real-time stock market quotes. So where will you get that? Then there's COL Financial that continues to offer research, of course, headed by April. And for if you would want professional fund management, there's Sun Life Asset Management, and that offers professional fund management. But the thing is, you need to stay invested, and you need to always start to look at your individual risk tolerance level. And the last thing you would want is for you to just jump in and say that I would want to enter the market because there's more opportunities, but you cannot handle the volatility. And you end up selling your losing position. So definitely there's a lot of opportunities, but there will still be volatility down the road, at least in the coming months. But the general direction in our view is the market will continue to recover. There's a lot of fear in the market, but that fear has continuously been dissipating. And we have been seeing that fear translate to more of fear of missing out. So I think with that, thank you, everyone.
Thank you, Sir Mike, for that closing statement. And also thank you for plugging in Investa and COL in your statement as well. So I think we still have time, I guess, for one or two questions from the audience. So let's have the first one. So this is from a certain Bea Amarilie. I hope I didn't butcher your last name on that one. The question is, how can we attract or engage more clients or investors to invest on the stock market, given the confidence on vaccine rollout and other market recovery indicators like elections coming up? So this question assumes that we're really inviting people to invest in the stock market, or we're advocating for more players coming in. So who wants to take a stab at this first? Who wants to go first then?
I can give some thoughts on it.
Sure, Miss April.
Yeah. Well, maybe again, you don't need to actually buy stocks directly. You can do it through funds like Sun Life, diba? And the good news is they've become very affordable at this point. You can buy an equity fund that is already professionally managed by fund managers like Mike, and I think you can buy for as little as 1,000. Correct me if I'm wrong, Mike. But yeah, I mean, you don't have to have a lot of money. You can start getting your feet wet by buying just a little bit, and be comfortable. So I think that's a good way to start. And over time, once you see, hey, this is a fruitful investment, then you will be encouraged to learn more and do your stock picking. Yun lang naman ang advice ko.
Thank you, Miss April. Anyone else? Sir Mike, Sir JC?
Well, probably I can weigh in more on that. And I think we, as what the group has mentioned in this forum, I think there are a lot of opportunities that presents itself now as markets have become very stressed. And we are coming from low levels. I know we rebounded, but I think this market continues to be at pre-COVID-19 levels. So there's a lot of opportunities for an investor to still come in, whether election related or coming out of the COVID-19 vaccine. I think we need to look beyond this year, and more so to see how this economy will be transformed as the government will start rolling out its infrastructure development program, heightening on mass transport, more toll roads, bigger airports. I think in the next 5 years, I think that would be the view that an investor should look at when they start coming in at this point in time.
Thank you, Mr. Mike. Mr. JC?
Yeah. So to add on how to engage or attract more Filipino investors, first component there is education, to show them the right strategies and to allow them to choose which path are they taking, what kind of framework fits your life, because some can afford to put time in the monitor, actively trade, make constant decisions, and manage their emotions. While for some, you're fully dedicated to your work, your business, then you'd be better off investing passively, whether in an ETF or on a fund, right? So, but the key point there is you have to understand how the market works, how volatility works, what are the ways to distribute your risk. So once you've covered that, then you can freely invest progressively, right? Whether you start on a low amount, such as what Miss April and Sir Mike said, you can start investing into funds for as low as 1,000 pesos or even lower, then that can be a good starting point. And then from there, you progress and study and develop your own strategies, and also develop your psychology with regards to money and your comfort level with risk as you go along. But then I just want to share, if you are looking for guidance in the stock market, just search on YouTube Investa University. We've covered the basics there of the stock market and some advanced topics, so you can go ahead and choose that. So it's really about, there's no perfect strategy. It's about knowing yourself, what will fit your life, and what strategy is sensible enough to give you consistent returns. But of course, it's very easy when we talk about it here in a forum, but in reality, it takes years of research, hard work, experimentation to really come up with that consistent strategy where you just go in and year out, and your emotions are really, I just like to share, if you've been a veteran on the market, what happens to you is the volatility of the market differs, but then your emotions are plain and simple because you've done your work. So regardless of the market sentiment, you know how to react and act and find these opportunities. So the key there is to really put in the work and develop your foundation as an investor.
Thank you, Sir JC, for that. I think we have another one, but this will be the last since we're running out of time. This is from Willie Reyes. Okay, so this question is, what would be a prudent mix of investments at a time like this? So it assumes just beyond stocks. So you have bonds, equities, ETFs, REITs, UITFs, etc. What would be that mix that you think is considered prudent? To answer this question.
Okay, probably I can start. Well, it's a very good question since we're on discussing about the Philippine equity market, but obviously there are a lot of other investment outlets there. For the equities itself, we've seen how the Philippine equity market performed last year versus global markets, more so the equity market in the US. So I think it pays to diversify, not only locally, but also offshore equities. And then if you would want to go across asset classes, there should always be somewhat of a fixed income component in your portfolio. But definitely before you start assessing your asset mix, you need to first assess your own risk profile. You need to find out what type of investor are you. But definitely it's always prudent to always put your money in several types of asset classes or in several types of currencies. In terms of, for example, equities, it can be domestic and the U.S. equities, because for the Philippine equity market, sadly, it's just a very limited index. Um, the sectors that are represented are sometimes not the relevant sectors, such as tech, healthcare, which are very abundant in the US. So definitely there's some logic for you to also look at investing in other markets, which can offer diversification.
Thank you, Mr. Mike. Is there something that you want to add, maybe Mr. JC or Miss April on this?
I
Yeah, I
mean,
can. You want to go ahead, JC?
okay, sorry. Yeah, I agree with Sir Mike. It's about knowing what your risk profile is, and then it really depends. If you're young, you don't really have to invest too much in super conservative assets. It really depends on your fear or risk appetite. But my general rule is you can experiment between what you on asset classes that you know. So if you're really adept at the stock market, then you can expose 60-70% or majority of your money for risk on the stock market, and then you diversify on the latter part, the 20-30% on other exploratory assets. Like example, if you're an active trader, you can try to experiment on having exposure on currencies, cryptocurrencies, though it may be radical, had a very strong run, so congrats on the holders. And then the other, for passive people, you can play around with a mix of funds or bonds if you're really busy. But don't mind my percentage allocation. So what I mentioned was 60-70%. That's for an aggressive type of person, of course. So now you have to tinker around, because there's no true secret formula on the percentage weights, right? That really depends on what kind of life you wanna design. So if you want to go with a high flying life, but then you can afford to lose, then you can put in bigger weights on risky assets. But then if you want a more stable, more emotionally stable and stable in terms of returns kinds of life, then you can increase the weight of your fixed income assets. So it depends on what you want.
Thank you, Mr. JC. Lastly, we go to you, Miss April, for this.
Okay. I just want to add. I mean, I think they've talked about it in quite good detail. Ang advice ko lang siguro, if you want to buy bonds today, don't buy the long dated bonds. Stick more to the shorter ones, because as the economies recover. I mean, first of all, interest rates are at record low levels, so there is a greater likelihood that they will go up instead of going down. And if you buy, say, 10-year bonds, you could get stuck with the very low yields for a very long time. So that's it. If you want to, there's nothing wrong with buying bonds, but when you want to buy bonds today, maybe, don't buy too much. And when you buy them, stick to the shorter term ones, maybe up to 3 years, ganon. So that at least when interest rates start to go up, you can easily switch to the higher yielding bonds.
Thank you, Ms. April. So that pretty much wraps it up for this virtual stock market roundtable. So we'd like to thank our speakers, Mr. Michael Gerard Enriquez from Sun Life, Ms. April Tan from COL Financial, and Mr. JC Bisnar from Investagrams. Also to our partners, Management Association of the Philippines, CFA Society Philippines, and Investagrams. And of course, to everyone who's tuned in and joined today's discussion. Thank you very much. So be sure to tune in to Business World's social media pages to be updated on our next projects. Again, this is Leo Uy, and this has been Business World Virtual Stock Market Roundtable.